The stock market is not a test you pass once. It is a process you practice. When the process is right, results follow with time. So I am going to give you the clearest version of how this works. No hype, no shortcuts, just the rules that hold up over decades. Most mistakes come from impatience, not from lack of intelligence. Let me start with why you should invest in the stock market. To start, the S&P 500, which stands for Standard & Poor's, is a stock market index that tracks the top 500 U.S. companies. This is one of the most followed indexes, and it is considered to be the best representation of the U.S. stock market. The best thing or fact that you should know about the S&P 500 is that it has been consistently trending upward and producing an average annualized return of around 8 to 10% per year since it got started. At the top of the list is stocks with 5.2%. You can see that stocks has the highest average annual return compared to other investments like treasury bonds, fine art, and other commodities like precious metals like gold, real estate, for example. Even comes in at number 10 at 0.3% over the long-term stocks have the most potential to transform your life because your typical big bank like Chase or Wells Fargo will offer you an interest rate of 0.1%, maybe 0.15% in your savings account. Think about pretend for a next that someone hypothetically gave you $1 million and you wanted to live off of that money for the rest of your life. If you were to put it all into a Chase savings account that, say, paid you 0.01% on your money, you would only earn $100 in 1 year. In my world, compounding is the quiet engine that does most of the work if you give it time. Now that completely changes things, right? Like you can live off $100,000 per year. That sounds pretty nice to me, and even at 5% that would get you $50,000 per year with $1 million balance. The thing about investing is that our money will work for us and compound over time, and the term compound interest refers to the interest that you earn on your interest, and this can be illustrated by the following example. Say you invest $1,000 and you get a 10% return in a year. By the end of year one, you are going to have $1,100 in year two. You'll get the 10% gain again, and now you are going to have $1,210 because you are getting 10% on the now bigger $27 by the end of it. So just by putting $1,000 in and getting a return every single year, you can see that your money starts to compound and grow even bigger upon itself. And the fourth reason I think you should invest into the stock market is simply because of inflation. The U.S. has a central bank called the Federal Reserve, which dictates the monetary policy of the entire country. They've said publicly that they target a 2% inflation rate per year to keep the economy healthy. But as of recent years, you might have noticed that in the news you might have seen inflation closer to 5 to 8% during the years immediately following the pandemic. That means if our money isn't outpacing inflation, let me say inflation is 5%, and if we are not earning at least 5% on our money, then our money is losing purchasing power just by sitting in that account. This is best illustrated with the example of the U.S. postage stamp. So in 1971, the postage stamp cost 8 cents to mail a letter. As of this year, it is 73 cents. The mechanics of the postage stamp are exactly the same. The stamp just gets you a letter. Let me suppose you earn $70,000 US a year. That is about the median household salary in the United States. So after taxes, you'll have right around $4,500 to $5,000 per month. So that is what you do. You put an initial deposit of $5,000 in there, and you are going to be adding about $1,000 per month every single month, the average annual return that we are going to put in is 8%, and the years to grow will toggle this to 30 years. And I want you to see the power of the compound interest that is working here in 30 years. Your portfolio balance will be over $1.5 million, and your total investment over time has been $365,000. While your profit is over $1.18 million, there are two factors at play here. One is that you are consistently investing your money. into the markets, and the next is that you are leveraging the power of compound interest and time. Let me say you were able to invest $2,000 a month this time and you got the same return. Look at how much more powerful this is, a $3 million ending balance. And you can see that most of the gains are towards the end, the key to investing. Then, in my opinion, is continually investing and trusting the process. Now, a quick note on how reliable the stock market is. Of course, you can lose money in the market. Some years are going to be down years. In 2022, for example, the S&P 500 was down close to 18%. And then sometimes in other years, you are going to be massively positive. Like in 2024, the S&P 500 was up 25%. And in 2023, I think it was up around 20% as well. He states that over any 20-year period, U.S. stocks have had no real negative returns when including dividends, and over a 30-year period, the returns have generally converged despite some dispersion. So that basically tells us that to accumulate our wealth in an aggressive manner, you should just keep buying no matter what. What investors believed at that time, they believed that the market was overpriced by 50% in some cases. But look at this graph from the S&P 500. In 2012, it was trading at 1,400, and today it is trading at close to 6,000, if not already over that. So at this point that we've covered that, let me actually go over what is the stock market and what is a stock. So basically the stock market is simply a marketplace that is at this point all digital. And in this marketplace, people are buying and selling stocks left and right. When you buy a stock, you are purchasing a small piece of ownership in a company, and you are typically buying it from someone that is selling it to you on the open market. Owning a company's stock gives you claim on its assets and earnings, and the stock market allows you as an individual to trade these shares, and the prices of these shares will fluctuate. Now, to quickly explain why companies would even want to sell their shares on the open market. The reason is that companies sell their shares on the open market primarily to raise money for growth and expansion. They like to raise capital. And this process is called an IPO, or initial public offering, giving a larger pool of investors access to that company's shares, including you and me, and therefore you can speculate on the price and perhaps the future direction of the company. You have a positive outlook on the future of that market or whatever you are speaking about. And the sentiment means basically that you would expect prices to rise in the future. You could be bullish on tech stocks, which means that you think tech will outperform in the short term or perhaps the medium term. At this point, being bearish, on the other hand, or a bear as they like to call it, means that you have a negative outlook on the market and you expect prices to fall. The easiest way to remember the difference between the bull versus the bears is that bulls typically have horns and the horns point upwards. And that is the direction you want prices to go if you are someone who classifies themselves as a bull. The next term you should know is an index. We've already covered this a little bit, but an index tracks the performance of a group of pre-selected investments such as stocks. So in the stock market, we have the S&P 500 index, the NASDAQ index, and the Dow Jones. Each of these indices tracks the group of stocks that make up that particular index. This next term is one of my favorite terms. It is called frothy. They might actually announce a dividend and pass it back to you. Dividends are often paid quarterly in the form of a cash or stock reinvestment. Owning dividend companies are one way that many beginner investors like to get into investing, because it is a nice way to get some passive income, and typically dividend-paying companies are large and stable. In our live demo today with one of the brokerages, we'll create a 5-stock dividend portfolio just as an illustration. So I hope you stick around for that. They're categorized in 3 different ways, either by market capitalization, sectors, or themes in terms of market cap. This helps you as an investor understand the size of the company and its risk profile. The way that it is calculated is by multiplying the company's share price times the number of shares that are in circulation. There are micro caps, which are companies valued at less. than $300 million small caps, which are valued between $300 million to $2 billion. Mid caps are between $2 and $10 billion. And then you have large caps that are over $10 billion in valuation. Technically, there are also some companies that are mega caps these days. These are your Apples, Nvidias, and Googles of the world. Now, micro-cap stocks are usually way more volatile, much riskier, can have a lot more upside because they're so small. They have tons of room to grow, but these are usually known as penny stocks, and as beginner investors, we are probably going to stay away from penny stocks because investing in penny stocks. So now let me actually talk about what to invest in as a beginner in the stock market. I think there are a couple of approaches that we'll go over today. The first approach is simply investing in individual companies. This approach can be very exciting because of its potential for high returns. But it is also a lot riskier. For example, let me say you have $1,000 in your portfolio and you decide to invest $200 each into 5 different companies. Let me say you have Nvidia in your portfolio and it tripled in value. Your $200 investment could turn into $600, significantly boosting your overall portfolio gains. However, the flip side is that if one of these companies performs poorly or even goes to zero, your losses could outpace the overall stock market returns. For example, if the stock market is down 10% in a year and you are invested in some companies that are down 50%, you may underperform the market in a more volatile year. And the name of the game with stocks and the stock market is that you do not want to underperform the market because the market is the easiest benchmark to hit. If you just invest in index funds, you will hit that market return. If you were to pick individual stocks, that is a tempting way to try to beat the market and build your wealth quickly. But it requires a lot of research, a lot of high conviction, and you simply have to accept that you might lose money or your portfolio balance will be very volatile. The next approach, and the one that is much simpler and more. You basically set it and forget it, relying on the market's historical average returns of 8 to 10%. Over time, an example of a fund that tracks the S&P 500 is ticker. Symbol VFIX, or ticker symbol VU, is the ETF version. A ticker symbol is like an airport code. You know how JFK references John F. An index fund will just buy everything that is in that index. Another similar option is called a target date fund that adjusts its asset allocation as you approach retirement. For example, if you plan to retire in, say, 2060, a target date fund will start heavily weighted in stocks right now and gradually shift towards safer investments like bonds. As the retirement date approaches 2060, refers to the date that you would want to retire, and these are most commonly found in retirement accounts like the 400 WONK. For most beginners, I think you either go with all. Keep in mind there are tax implications too for different strategies, which I will cover later. But the key takeaway is this. You want to focus on building a portfolio whenever you are buying a stock, you need a special account to buy it in. You just cannot buy it in your bank account. You need something called a brokerage account or a retirement account like the IRA, the Roth IRA, or the 400 WONK. Once you have one of these accounts, you can then transact your stock or your index fund. Purchases, the most common type of an account, is a brokerage account. Now within these brokerage websites, you can open up what is called a taxable brokerage account. That is the standard brokerage account that most people will use to buy and sell stocks in. You can also open up a retirement account like the individual retirement account known as the IRA or the Roth version of it. Like the Roth IRA, the 400 WONK plan is something you need to set up with an employer. Now my favorite account to trade in is the Roth IRA. If there is one takeaway you remember from this guide, out of everything it is to start a Roth IRA, because the benefits are incredible. This is an individual retirement account where you put in after tax dollars, but as a result, when you invest within this account, all your earnings are tax-free. The contribution limit on it is about $7,000 per year as of 2025. That could change in the future. It might go up to $7,500, but right now it is 7,000. Now here is the power of that account. Let me say you have Apple stock in a Roth IRA and you buy Apple stock regularly. Let me pretend in 50 years I do not know. You make about $2 million from it. You wouldn't owe any taxes on those gains, versus in a normal brokerage account you might owe 15 to 20% in taxes on those gains. In a normal brokerage account, gains are taxed, and we'll talk more about taxes later, but in a Roth IRA it is completely tax-free, and that is why it is so powerful for now. You just have to know we need a special account to actually trade in, and you'll either set up a Roth IRA or a taxable brokerage accounts, and then you will trade stocks in them. So suppose talk about researching stocks now, because it is a very important part of this guide. There are two camps that investors usually fall under. There is fundamental analysis, and then there is technical analysis. Investors who love fundamental analysis attempt to figure out what a company is worth intrinsically, which means they're trying to figure out the true value of a company based on the underlying company's health, like their revenue, their profits, their cash flow, their assets and liabilities, as well as their position in the market. Investor to buy Google over NVIDIA. Another approach is called technical analysis. These are traders that are trying to identify ways to make money on stocks through patterns on a stock chart. They do not really care about fundamentals. They're just simply trading the price action or the trends and movements on certain stocks on a day-to-day or short-term basis. A fundamental investor is someone who is more likely going with a longer-term approach. The fundamental person buys an undervalued company, and the goal is to invest in these. They bring home after all these costs, and these are general overview numbers that are good to keep in mind as you dive more into the company's other metrics. The third, which is a big one you need to know, is there are general benchmarks for what a healthy P/E ratio looks like depending on the sector or industry that you are trading in, and usually that varies a little bit, but you can, for every $1 of profit that Apple produces, a higher P/E ratio, such as 38, often suggests that investors expect strong future growth or view the company as a high-quality business worth paying a premium. For NVIDIA, on the other hand, trades for around a 53 P/E ratio, which suggests that the market is pricing in a lot of growth for this company, perhaps because of all the innovations surrounding it, including the chips that they're making for AI. So now let me talk about creating a portfolio. When it comes to creating a portfolio, there are first a few questions that you need to ask yourself. First is to figure out your investing style, to understand what type of holdings that will fit you within your portfolio. Chances are you probably inherently know if you are more on the riskier side or more conservative side. And if you do not, there are questionnaires online that you can fill out too. After you've identified your risk profile is how long you are going to invest for this. In the investing world is known as your time horizon, and it needs to be answered before you invest. So if you are investing for, say, retirement, you can likely contribute and invest and feel. Beginners is something called the 3-fund portfolio. It is a great approach that is set it and forget it. And this is where you buy 3 ETFs. One covering the U.S. stock index, one covering the international stock index, and lastly, you have an ETF of bonds. This gives you a diversified, low-cost portfolio that can weather almost any market condition, and my personal 3-fund portfolio will. Now, the entire premise of the 3-fund portfolio is that since even professional active money managers have a hard time beating the market, the average investor would just fare way better if they simply invested in index funds and ETFs. So all we have to do as DIY investors is to make 3 investments, and we'll not only have a good, well-diversified portfolio with an appropriate level of risk, we'll also have the potential for market returns, if not better, in terms of how you allocate your total. If you do not want to do ETFs or index funds and would prefer the individual stock method, you can do that too. I would just say that with individual stocks, you need to be a lot more purposeful in the ones you do choose. And if you are choosing a basket of, say, 5 to 10 individual stocks, At least make sure you are well diversified across different sectors or categories. You wouldn't want 10 tech stocks. Because if the entire technology category starts to underperform, this could have a huge negative implication on your portfolio balance. All right, so now this is a major brokerage portion of the video. I am going to show you how to buy a stock using the mobile app. So that means you can buy one full share, or perhaps if you simply want to buy $100 worth of the stock. You can choose the dollar toggle right here, but for the sake of this guide, you can look up some tutorials online for the sake of our video. We are just going to click Market, and then I am going to click Preview Order. So let me actually click that, and this is what the order preview looks like. As you can see, we haven't bought the stock yet. We still have to place order. Imagine you buy fractional shares. So if you put in $50 right here, you can see that the estimated number of shares that you get is 0.797. This is a fractional share that not many other brokerages might offer. So what is really great about a major brokerage is that they let you buy fractional shares, which means that it is a little bit more flexible than some of the other brokerages out there, and you can even buy fractional shares of ETFs as well. Now let me talk about taxes on stocks, because this is going to be pretty important when you are making gains in the stock market. Whenever you make a gain in the stock market, you will owe taxes to the government. I know it sucks, but in the United States, at this point, please note, in order for you to actually pay taxes on the stocks, you actually have to realize the gain, which means that you would have to sold the stock that you made money on if you simply bought a stock and simply held it indefinitely. You do not owe any taxes. It is only when you sell the stock and you actually make that gain. Then you pay the taxes. Now there are two tax treatments for stocks, either short-term or long-term capital gains. A short-term capital gain occurs when you hold the investment for less than 1 year and therefore is taxed at a higher rate. It is typically your ordinary income rate, which is the tax rate that is based on your incomes. So as an example, let me pretend you buy $1,000 worth of Apple stock in January, and then let me just say it doubles. So it goes up, it is great, and you sell it for $2,000 in June of the same year since you didn't hold the stock for a full year. You will owe short-term capital gains taxes on the $1,000 in profit that you took if your ordinary income tax rate is 35%. This is why if you are able to sell a stock after holding it for a year, you will pay considerably less in taxes. The long-term capital gains rates are roughly half the rate of short-term capital gains rates. It is typically 15 or 20% depending on your income. There are also some cases where if you do not make that much money on a yearly basis, the long-term capital gains rate is actually 0%. But that is if you make less than $47,000 a year. So obviously there is a huge difference here, but I think the most important thing to note is that you shouldn't let taxes control how you buy and sell or invest. Some profit than not have any profit at all if you are on day 364 and you have a massive gain and you want to get out of that position. Then, maybe I would tell you to wait until day 365 to sell that. Have at a loss in order to offset any gains that you might have incurred throughout the year. This is why, new example. Let me say you take $10,000 in profit in the markets over the course of this year, but you have one pesky stock position, let me pretend it is GameStop, and it is down $4,000 this year. That $4,000 loss of GameStop, if realized. This is why if you sold it and you actually lost $4,000, you can offset the taxable gain of $10,000 by that corresponding amount. That way you reduce the amount of taxes you pay, because now your yearly taxable gain is now only listed at $6,000 total dollars. Now, one way to avoid taxes altogether when buying and selling stocks is by investing through a Roth IRA, which we already talked about earlier in this guide. If you do have further tax questions and you do not know how to answer them, make sure to consult with a CPA or tax attorney that can help you more than this guide can. All right, if you remember one thing, remember this. The market is unpredictable in the short run, but behavior is controllable. Keep your costs low, diversify, and stay invested through the noise. That is how compounding becomes real.